All right, let's get right into it. Today, we're going to break down the four fundamental pillars that basically hold up the entire global economy. My goal here is to turn these complex ideas into something you can really grasp.
So what are they? If you really want to be a smarter, more informed investor, you've got to understand the landscape. And it's all built on these four major pillars: equities, forex, commodities, and derivatives. By the end of this, you'll know exactly what each one is, how it works, and who it's for. Let's break it down.
At its very core, a financial market is just a way to move money around. It takes capital from people who are saving and investing it and channels it to businesses and projects that need it to innovate and grow. You can really think of it as the current that powers the entire global economic engine.
Okay, let's start with our first pillar, the one most people are already a little bit familiar with: equities. You probably know it by its more common name, the stock market.
Yep, that's it. It really is that simple. When you buy a stock or an equity, you are literally purchasing a tiny slice of ownership in a public company. Could be Apple, could be Tesla, could be anyone. You become a part owner.
So why do people do this? Well, there are two main ways you can profit. Either the stock's price goes up and you sell it for more than you paid, or the company shares its profits directly with you through payments we call dividends. It's that classic strategy for building wealth over time, because you're basically investing in the long-term success of the world's biggest companies. This one's for the patient investor.
All right, let's move on to our second pillar. Now we're shifting gears from owning a piece of a company to trading the actual currencies that those companies use. Welcome to the Forex market.
The sheer scale of the Forex market is, honestly, it's staggering. $7 trillion are traded every single day. That makes it, by far, the largest and most liquid financial market in the world. And when we say liquid, we mean you can buy or sell currencies almost instantly, 24 hours a day. It absolutely dwarfs the stock market.
So what exactly is being traded here? In Forex, you're always trading one currency against another. You're speculating on whether the value of, say, the US dollar will rise or fall compared to the Indian rupee, or the euro, or the Japanese yen. It's always a pair.
This really highlights the key differences, right? While the stock market is all about how well a company is doing and operates during set hours, Forex is this 24-hour beast that's influenced by huge-scale economic factors. Things like a country's interest rates, global trade flows, and even geopolitical events. It's a totally different playing field, and it's often favored by short-term traders who love that kind of volatility.
Our third pillar takes us from the digital world of currencies to the physical world of raw materials. We're talking about the tangible things that are grown or mined from the earth, the actual commodities that power our daily lives.
Generally, commodities are split into two main camps. First, you've got your hard commodities. These are things that are mined or extracted, so think gold, silver, crude oil. And then you have your soft commodities, which are all the agricultural products that are grown, like wheat, coffee, and corn.
So why would an investor even bother with commodities? Well, they usually play two really key strategic roles. When stock markets get shaky, investors often flock to assets like gold as a safe haven to protect their money. They can also act as a hedge against inflation, because think about it. As the cost of living goes up, so does the price of these basic raw materials.
And now for our fourth and final pillar, derivatives. I know, the name might sound a little complex, maybe even scary, but the core idea is surprisingly simple. We're really just talking about financial contracts. A derivative is just a contract between two parties. But here's the crucial part. Its value is derived from some other underlying asset. So, for example, a contract to buy oil at a certain price next month gets its value from what the price of oil is doing right now and what people think it will do. The contract itself is just a piece of paper. It's the oil price that gives it value.
Derivatives really have two main jobs. They were actually invented for hedging, the first purpose. Just imagine a farmer who wants to lock in a guaranteed price for his wheat harvest months before he even harvests it. That's a derivative. But today, they're also widely used for speculation. This lets traders use what's called leverage, basically using borrowed money to control a large position to make huge bets on where they think an asset's price is going. And because of that leverage, you have to understand that derivatives are a double-edged sword. The potential for reward is absolutely immense, but so is the potential for catastrophic risk. This is the deep end of the financial pool, and it really requires some serious expertise to navigate safely. This is a space for the pros.
So, there you have it. Those are the four pillars of finance: equities, forex, commodities, and derivatives.
Each one offers totally different opportunities and different challenges, and each attracts a different kind of investor. Just understanding these fundamentals is your first huge step toward navigating the financial world with a lot more confidence.
So now that you've got a map of the financial world, where are you going to explore first? Let us know in the comments which pillar you want us to cover in more detail next. Thanks for tuning in, and we'll see you in the next one.